Good afternoon. Gautam, clearly as Prime Minister Modi was also saying that budget ki sarahana to ho rahi hai across the country, be it brokerage reports, institutional guys. You tell me, you must have spoken to a bunch of institutional investors and clients of yours. What are one or two things which stood out in your conversations from the internals, and one or two areas of worry or wrinkle where you would have wanted a little more clarification, or perhaps another way?
Hi, Ajay. Good afternoon. So I think this is a pretty decent budget, shorn of all the drama. This is a very simple and short sort of a budget, which has not created any negative for the markets, right? There are a lot of worry points before the budget. This will happen, that will happen. Nothing of that sort has happened. This is passed off in a very uneventful kind of a way. The most important thing, Ajay, second year in a row is that the numbers and the budget maths is looking very credible and transparent. This is a very welcome development because till about 2 years back, there used to be a lot of doubts whether these numbers are doable, achievable or not. I think even in FY23 budget estimates, if you look at the revenue receipts, the expenditure receipts, there is a sufficient room for upside. Forget FY23, even in FY22 revised estimate itself, it seems that the actual numbers can beat even the revised estimates. We do believe that the revenue receipt itself for FY22 could be higher by about 1 trillion to 2 trillion rupees versus the revised estimates, right? So that is a pretty welcome development because generally we always think whether these numbers will get delivered or not. So being transparent, being credible helps the markets. Second, the thrust of the budget over the last 2-3 years clearly has moved away from pump priming through consumption towards building long-term infrastructure and then driving the infrastructure creation through capex spends and investments in the economy. So that seems to be a clear focus. If you put a microscopic lens on different expenditure line items for FY23 budget estimates, you will notice some redistribution of expenditures, and that basically underscores the priority of the government. So FY21-22, they went whole hog on welfare spending, the food subsidies and Manrega, etc., etc. Now there is a normalization in those line items, and you are seeing the focus shifting away from there towards the capex and investments. So your Manrega allocation is down, your fertilizer subsidy is down, and your capex investments are up, right? And of course, because of the higher debt over the last 2 years, both central and state, you can clearly see interest cost element of the budget P&L is going up significantly over the last 2 years, from 6 trillion odd to about 9.1 trillion kind of a number. But I still believe that these numbers have sufficient upside left on the revenue side because you're assuming just about 11% nominal GDP growth, whereas the economic survey pointed out that they're looking at a real GDP growth of about 8.5%. And if inflation were to average somewhere close to 5.5% as well, you're talking about a 13.5 to 14% nominal GDP growth, which creates some upside for your revenue estimates. Even the tax buoyancy has been taken at a very conservative 0.9x, which also has a room for surprise. So I think while the fiscal deficit 6.4 has created some flutter in the bond market, 6 months down the line or 9 months down the line, there is a possibility that government has a degree of freedom to ensure that the fiscal deficit can come in at about 6.2 or 6.3, unless they decide to use the revenue buoyancy and increase their expenditure, because the overall expenditure growth is just assumed at about 5%. From a market's point of view, I would have loved if there was some more push towards consumption, if there has been some more relief measures towards the bottom end of the pyramid as far as income strata is concerned, because that is one segment which has suffered in the last 6-9 months, and corporate commentaries are clearly bearing it out. If you go through the recent quarter commentaries as well, staples, two-wheelers, they're clearly feeling the brunt of demand slowdown in the rural areas. So I would have loved if there would have been a slightly more higher allocation towards that. So those two segments are, I think, slightly disappointing. And on the positive side, clearly financials to me looks very well placed now. If this capex happens as we move forward in FY23, clearly the loan growth in the system will pick up, and large cap banks will definitely benefit more because they've been gaining market share for the last 2 years. Plus, the real yields are also going up. That also augurs well for some of these large private lenders because the loans will get repriced faster than the deposits. So yeah, but now the focus, I think, will shift towards the forthcoming RBI policy, which I think is a equally important event, if not more.
Forget UP elections, March 10th, then the clarity would come there as well, and probably that will also be something which the market may watch very closely, isn't it?
Yeah. UP is always a very important state whenever there are elections in UP because specifically for this government, both NDA 1 of 2014 and NDA 2 of 2019, UP has been a big contributor to their overall tally when they had 282 and now when they have 303. So UP becomes a very important from a national politics viewpoint. And of course, you have 4 more elections, which while they are small in terms of their contribution to the Lok Sabha seats, but yeah, I mean, this kind of state elections will always, drive the narrative. I, however, don't think this is a semi-final or some sort because state elections are always fought on different issues than the national elections. We also have another round of big elections in 2023 towards the later part of the year when you have MP, Chhattisgarh, and Rajasthan, which will go for elections.
Never a dull day in the markets, and strategists like you always are on toes, explaining each small or big event and, of course, talk to the clients. But coming back to that point, I want to scratch that point. What is the order of priority in financials, private sector banks, PSU, or even NBFCs? How would you have to play that spectrum?
Yeah, so we are we have a big overweight on overall financials as a space, about 300 basis points. Actually, it's the second largest overweight. The single largest is IT, which continues to be a big overweight for us for 2 years now. That is also at about 300 basis points. Within financials, to answer your specific questions, we like private banks, we like SBI, and we also like select non-lending financials apart from NBFC. So in private banks, it's an obvious choice. You have a big allocation to ICICI Bank, a huge overweight to SBI in our portfolio over the last 2 years. That has worked out quite well, and we're continuing with that because we expect very strong delivery of numbers this year as well as next year, and the valuation still has room to expand in case of SBI, right? And the numbers which have come in so far from the other 4 private banks which have reported, the large private banks, clearly suggest that there is a pickup sequentially in terms of loan growth, NII growth, and asset quality remains extremely strong. Now, we have seen 2 years of pandemic. There's been absolutely no stress on the balance sheet, which we have seen in the case of this top 4 private banks. And in terms of numbers also, if you look at, you step back a little, FY18 Nifty Financials did a profit of 45,000 crores. And FY21, they did about 1,11,000 crores. This year, we're expecting 1.5 trillion. And then FY23, we're expecting 1.9 trillion. So the going is going to remain pretty good as far as earnings are concerned. Stock prices have to catch up because they've underperformed the last 2 years.
Excellent data point, Gautam. That's why I really enjoy chatting with you, because in small data points, you put your point in perspective. How would you play, what's your hypothesis on IT now, despite the fact that there were 2 very good years, but people still, not everybody could, a very small section actually participated in the entire 2-year time frame. People are warming up to it now, and now the performance versus valuations are kind of coming closer. So how do you play the cycle on large cap IT from here on top 4 or 5 names? What is the order of priority? Do they still remain buy on dips?
Yeah, absolutely, Jeb, because this is one segment which is actually benefited after COVID. In most of the other sectors, you're still talking about whether it is 70% of pre-COVID, 80%, 90%. IT is one sector which has crossed pre-COVID numbers by a big mile, right? If you look at the demand commentary, it is extremely strong, whether you talk about digital transformation, cloud, and so many other areas of spend. We have to go through the commentaries of the top 5 IT companies which have reported the numbers. The problem there is of supply. As we all know, the talent crunch is very clearly apparent there. And therefore, there is an element of some wage inflation, attrition, those kind of things, which we have already seen actually play out in terms of their operating margins. But what has also changed incrementally over the last 6 months in IT is there is a discussion on pricing now, which is back on the table. So that may help their sequential margins going forward. And the best thing about IT is entire profits get converted into cash flows and then they are returned to the shareholders. So payout ratios are upwards of 80, 90%, frequent buybacks, right? And free cash flow conversion upwards of 100%, whether you look at Infy, TCS, SCL Tech. So the capital efficiency is one of the best and demand is extremely strong, while they are still growing at about 15, 16% at an aggregate level if you look at the Nifty IT companies. And valuations after the correction in January has become slightly more palatable now. So relatively, we prefer large cap because that offers slightly more valuation comfort. And of course, the ROEs are much higher there. Payout ratios are much higher. Free cash flow conversion is also much higher. So my preference is with the large cap IT. We have Infy, TCS, and SCL taken our model portfolio. And on the mid cap, we have L&T Technology.
Quickly tempted to ask, what is your order of preference and the names as far as capital goods go? Because on expected lines, there's a lot for infrastructure, engineering, capex. How to play the capital good basket?
Yeah, so and I'm not going to add too many insights when I say L&T is the preferred choice, because that pretty much remains the preferred choice for everybody on the street. And that will be a single largest beneficiary of a capex cycle as and when it revives. So far, it has not actually. Last year also, we had seen a big announcements and discussions around capex, but the numbers betray that so far. But yeah, I mean, the thrust of the government is clearly visible on the investment capex side of the economy. So with some lag, you will see it reflect in the order books and revenue and margins of the capital good companies as well. So yeah, I mean, as far as we are concerned, we have L&T in the model portfolio, but L&T in a way is also becoming a play on IT nowadays, given the SOTP and the big contribution of those three IT companies that contribute to their SOTP. If you look at the last 12 months of performance of L&T stock price, large part of it has accrued because of the underlying rally in the IT stock prices that are housed under the L&T SOTP. Aside of L&T, we like Bharat Electronics there. We also like EBB. But I think we are also playing this whole investment/infrastructure theme through cement and metals. Right? Cement prices have corrected a whole lot. I'm saying stock prices because the numbers have been bad this quarter. You've seen a big dent in the margins. EBITDA per ton has come off from 1,200, 1,300 to just about 700, 800 rupees for 2 or 3 companies which have reported numbers so far. But if government is going to build roads, government is going to build houses, and n number of other areas of infrastructure spending, it is going to reflect in cement consumption as well as we go forward. Plus, the cement balance sheets are also reasonably well deleveraged now after the last 2 years of the deleveraging that has happened, whether you look at Ultratech or Dalmia or other companies in the cement space. And metals is another indirect play on infra, but it is obviously governed more by what happens globally, what happens in China, and what is the underlying LME prices. Even in metals, we have seen a reasonably strong deleveraging play out over the last 2 years, almost in all sort of companies. So this is a basket of 3 different sectors through which we are trying to play the capex theme.
I've always enjoyed chatting with you today. Thank you very much for your time.